Hi, everyone. My name is Jake Estes. I'm a solutions engineer for Avalara Europe. Today, we're going to be talking about understanding DDP, or delivery duty paid, as well as in the context of global compliance, how to automate your DDP processes when you sell cross-border. Okay, so the reason for our lesson today, I guess, if you will, is that we're going to also be providing to all of you a guide, a DDP guide for selling cross-border. So the guide will be available shortly, and it will cover everything you need to know about DDP. It'll go into way more detail than I'm going to go through today in our time together. It'll talk about automation in more detail, best practices when implementing automation around your cross-border sales, as well as specific information on post-Brexit handling, and how to deal with the VAT and customs, whether you're selling into the UK from the EU or from the UK into the EU. Okay, so without further ado, we're going to get started. So first off is the term Incoterms, right? And what it's short for is international commercial terms. And you've probably heard this when you talk to your carriers or other logistics providers, and it's something that has to be addressed on every single cross-border transaction. Okay, now there are about 11 or so different Incoterms out there. The ones that you're going to encounter the most in B2C retail e-commerce are going to be two different terms, and that's DDP, of course, and then DAP. Now, DDP essentially means that you, the retailer, accept all the responsibility for, amongst other things, the import taxes, tariff classification, customs, and shipping liabilities. It's things like insurance that have to be considered as well. But in the context of tax, this is what you're going to focus on. And as part of that, and you know, you're going to have to do a lot more work essentially to provide an optimal customer experience. As a retailer, you need to take responsibility for mapping your products and product categories to harmonized system codes. And with that, each of those codes for each of your destination countries will have a different rate of duty associated with it. So you're responsible for finding classification, and then of course figuring out what the rates are when you go to import that product. The second Incoterm that we're going to talk about a little bit today is DAP. Now, DAP is kind of a way for you as a retailer to take on less responsibility and kind of move the burden of handling the taxes to your buyers, to the end consumer who you ship it to. But DAP stands for delivery at place. And essentially all you're taking responsibility for as the retailer is getting the goods safely to the customer's front door, making sure that you and your carrier have a good relationship and getting that product out the door as you can and to the customer's hands. You're not dealing with taxes, you're dealing with HS classification, you're kind of, you know, again, shifting the work onto your buyers. Now, it can leave a sour taste in some customers' mouth, you know, if they get charged with something that they weren't expecting in order to have the goods cleared through customs. But, you know, sometimes it makes more sense as a business to do DAP under certain circumstances or in certain countries and do DDP in others. It's really a business decision that you need to make because there are risks and rewards for each of the different Incoterms that you are going to have to address. Okay. To dive into this a little bit more detail, without selling DDP or not selling DDP, meaning you're not taking responsibility for the taxes, you run the risk of, first off, not dealing with codes at all or assigning the wrong codes to your products, meaning your customs declarations will be incorrect. Your parcels will often get delayed at customs if you're not handling the classification yourself. Sometimes your carrier or some other partner can interpret the product as something other than it is, and the customs authorities will catch on to that, and they will delay the processing of that good in the customs in the port that it arrives at as they reclassify it and communicate with you and your carrier. You get additional fees for this, penalties sometimes. If you're a repeat offender, meaning your goods are always misclassified, it can raise red flags and trigger an audit in some circumstances. But you can pretty much bet on there being some kind of financial penalty for consistently not getting the right codes associated with your products. Sometimes if you don't respond to the customs authorities inquiries and they hold on to it for a while, at a certain point they'll just destroy it. So the product isn't in your hands and it's not in the customers, it just gets destroyed and you're out some money, unfortunately. In addition to the paperwork and the compliance, without the right codes, they'll also won't be charging the right tax. So as I mentioned kind of in the previous box, it's increased exposure to VAT, fines and penalties, interest, things like that. It all kind of compounds on top of each other when you get it wrong. Shipments are often flagged at the border by the customs authorities. And again, when the taxes are maybe there, but they're not correct, if you're under collecting or have under declared the value of the products, you have to pay additional funds. So that's no fun. And sometimes if you're not taking responsibility for it, of course, the customer has to deal with this, not you. The customer's got to pay the additional fees. So if you are selling DDP, but you don't get the tax rates correct, it's the customer ultimately who's got to pay the difference there. And sometimes customers just flat out refuse the shipments. So in certain circumstances, if the customer gets hit with a hefty tax bill from the carrier, and then maybe they're paying double what the products actually cost, which happens in cases like in India, for example, or Brazil, where tariff rates, duty rates are really high on many consumer goods. Customers just flat out refuse it. It gets sent back to you. You're responsible for any shipping costs and potentially some associated handling fees that the carrier may impose as well. Now, what Avalara aims to solve is all of these problems, and that's through it's kind of four different pillars, four different considerations in the context of international taxation. First off is tariff classification, finding, how is the T-shirt that you sell, what is it made of, who is it for, right? And what is the HS code for the countries that you are shipping it into, right? And that makes sure that your taxes are correct and that your paperwork is correct. We handle assessment of your import taxes, to the VAT and GST and any other consumer-based import tax that a country might impose. On top of that, there's duties as well. So there's import taxes and duties. They aren't mutually exclusive, unfortunately. So Avalara automates the duty calculation piece as well. And then, of course, in the US, they don't have import VAT or GST. They do have duties. They got something special called sales tax, as this group probably already knows. But Avalara, of course, automates the collection of the US sales taxes and the reporting of those taxes to the relevant state authorities as well. Okay, so with all four of these, tariff classification, import VAT, duties, and US sales taxes, Avalara does have you covered from a technology perspective. Okay. To dive into a little bit more detail on HS codes, because I did talk about classification and I have, for the last few minutes, just to illustrate kind of the issues that you're going to encounter is that on its surface, HS classification can seem pretty straightforward. You have a standardized system, harmonized system of codes internationally, but these are standardized to the first 6 digits. Now, so to the first 6 digits, it's not terribly hard to find a code for this pair of slippers, right? Probably leather slippers. And the problem you can encounter is that different countries have different extensions of these codes. So you might have 3 to 6 additional digits on top of the internationally standardized 6 that define both the duty rate and statistical reporting of that product in the destination country. So for example, we see that this pair of slippers is 6405.90, internationally recognized. Below that, Australia adds an additional 4 digits, 0001. The US adds also an additional 4 digits, 9067. Japan only adds 3 additional digits, and it's 119. And you can see that below, there's 3 different tax rates. So Australia treats the slippers different than the US, different than Japan. Japan seems to have a very high duty rate for this pair of slippers, right? It could be for political reasons, statistical reasons, protecting domestic industries and things like that. But ultimately, you as the retailer are responsible for making sure that your HS classifications are correct, to make sure that, of course, your paperwork and your taxes are accurate as well. Now, I mentioned earlier, kind of alluded to this, customs duties and import taxes are 2 different things, but they're kind of like cousins, and they are related, and they can apply to, I would just say they would apply to most imports. There are considerations for both. Now, first is that the customs duty is non-recoverable. So if you're familiar with, input VAT here in Europe, and you can recover the input VAT. Customs duties aren't like that. Customs duties are non-recoverable. You pay them to the government keeps it, and that's it. That's the end of it. They are derived from HS codes, meaning that every code you have will have a duty rate associated with it. Now, separately, import VAT is also imposed on the importer, but it is recoverable, right? As you know, if you import in the UK, you can use a C79 import document to recover the charges that you incurred on your imports. The import VAT are not generally based on HS codes, but they are comprised of a percentage, it's an ad valorem tax, and a combination of the selling price plus the duty. So you not only have to take into account the value of the product, but also the value of the duty rate that's applied first. And that's how you calculate the import VAT or GST. And these can be calculated using an Avalara code instead of an HS code. These are frequently in excess of 30% of the value of the product, so they can get very, very high. Some countries, of course, are higher than others. Products are higher than others, things like that. But ultimately, it can be quite a large additional charge that either the buyer or the seller has to deal with. Okay. Now, sometimes there are imports that aren't subject to any taxes, which is great. It doesn't happen on very frequently, but for smaller shipments, it does. So they can apply to customs duties. There's a separate threshold for import taxes, or both, and they are country specific. So here's some examples on the right-hand side. You can see Canada's got a fairly low de minimis threshold for duty and import taxes. France has 150 euro threshold for duties, zero for import VAT starting July 1st. The UK, US, you can see it does vary tremendously by country. So as a retailer, it's hard to track this information. So if you've got mixed shipments, large shipments going out, some small shipments going out, high value goods versus low value goods, a mix of all different things, you have to track de minimis thresholds, and it becomes a lot more problematic, a lot more complex, okay? So, this sounds very daunting perhaps, but it doesn't have to be. So there are tools out there to automate all of this. Okay, now with Avalara and Avatax, what we do is we automatically map your HS codes to your products, and then use that information to calculate the import taxes and the import duties. So we take, you're essentially your item master, item information, product master, catalog, right? Whatever you send us, we look up descriptions and we look up the URLs of the websites that you send us to, the countries you sell into, other key attributes of the different products that you sell, and then we produce HS codes for every destination country. You then store that information in our tax engine, which then hooks into your e-commerce platform, right, or ERP or your billing system, and then we calculate the taxes there in real time. So if tax rates change, rules change, new trade agreements are implemented, Avalara has all of that tracked, and we apply the correct duty and tax rates for you, okay? So some key takeaways for DDP: it does provide the optimal customer experience. So if you or your customers want to sell DDP, it becomes a lot easier nowadays as there's more automation tools out there. So the excuses for not selling DDP are slowly over time becoming kind of few and far between, but Avalara's technology certainly supplements what our retail customers would like to do in terms of classification and accurately calculating duty rates internationally, not just in Europe, for example, or Asia, but globally. Okay, and it avoids poor customer experience. Okay, so end user poor customer experience. So parcels don't get delayed when you have accurate codes. There's no additional taxes that have to be dealt with. Customers don't refuse shipments anymore because the retailer is transparent with all the costs involved in getting the product from A to B on their website or wherever they sell. So with that, I'd like to say thank you very much. Just a reminder to check out our guide to DDP. It's very, very thorough, has a lot of great use cases, and is written by a team of experts here at Avalara. So do make sure and check that out. But if there's any questions, please don't hesitate to contact us. We're happy to help, so get in touch. But thank you very much.